To look more closely at what's happening on world oil markets and global commodities, I'm joined by Jonathan Barratt, Managing Director with Commodity Broking Services. Jonathan Barratt, welcome to the program.
Good morning, Whitney.
Now, what a difference a week makes. We've seen global markets reverse their negative position, and they're now clawing back gains, and with that, commodities are also, they're falling back. So what's your view on the picture that we're seeing at the moment?
Look, it's a sigh of relief that oil has come back from 100. At 100 and 105, it was very hard for economies to try and steer growth. But when you saw oil down at 85, through even down to 80 or 77 was the low, it sort of sent a sigh of relief where I thought, well, we're back to prices which actually mean something, which allow economies to be able to perform a lot better. Remember that having oil from 100 to 80 or 85 is about a 15% saving to the bottom line of expense for a lot of companies. So in my mind, that's a very positive step in the right road to recovery.
Many expect volatility on equity markets, though, to remain. So would you say that this is just sort of a sort of calm in the biggest storm?
Not this time around. I mean, one of the wonderful things I've got that we feel about what's happening in the equity market is that Bernanke and the Fed, they're not putting stimulus in. They are keeping interest rates at ultra lows, and that's important. But they're not providing us with stimulus. On the back of that to me has to be very, very positive. I actually feel that's the first step in the right road to a proper recovery. And that's what I think we're going to live through. So equity prices, I think, will start to trend higher.
Now, $87 a barrel for oil, will it consolidate around these levels?
Look, I think if oil below 85 is very, very cheap. 85 to 80, I think it's cheap to where you'll find OPEC probably come in and start to say, hey, hang on, it is too cheap. We're going to have to start to do something about restricting supply. So I think we're getting in a balance area. I think anywhere over 95, 100 is too expensive, but I think anything sub 85 I think is too cheap. So if anything at the moment, I would probably see prices tend to gravitate back to the top side as we get this sheer amount of optimism coming back to the equity market, because if the equity markets are optimistic, they've got to be optimistic about demand, and as a result of that, oil should slowly follow suit.
Now, what's happening with Cushing? You say that stocks have dropped there.
Well, this is a really interesting play at the moment because we're seeing West Texas price actually drive quite substantially higher. Stocks, inventories at Cushing are actually down by 17% over the last 2 months. Now, that's a first. We've been at historic highs for some time. So there's actually been a change in what's happening there. And it is as a result of the spread differential between Brent and West Texas. Normally those two only ever traded between $2, but at the moment it's $22.
And why is that?
It's an arbitrage. It's an arbitrage because what they can do is, it's the refiners. They can refine West Texas at a profit and obviously ship it over to Europe. So when you look at that sort of thing, we're seeing a demand come out of Cushing right into the rest of the market, which would relieve some pressure. But because Cushing is the lead contract for West Texas, we could probably see that price continue to push higher as well.
All right, let's move on to gold. Now, we saw that stellar rise last week. That was over $1,800 an ounce, which was quite extraordinary. Now, it's back below at $1,750. So will it stabilise here? Look,
it is interesting because we had a good positive night last night for gold. In my mind, at $1,815, it just went too far, too fast. But sure, we had issues out, geopolitical issues, debt issues, they are out. Now we're coming to an instance where that's all coming back. We're not seeing as much panic out there. Equity markets are stabilising. Europe's having a meeting tonight over their sovereign risks. So you start to think, why am I going to start to buy gold? Is it on the back of the financial difficulties? Is it on the back of inflation problems? Or is it on the back of a weaker US dollar continuing to weaken? So I think the rhetoric has to change as to why we're going to buy gold and the reason why we won't buy gold. So I think, to me, that's what the market's going to try and work out. What is the next step and why?
Now, late last week, during this whole turmoil, the bulls were saying $2,000 in the next month or 6 weeks. Too bullish?
Look, I think given where we are, the set's out there. I think all the news is out there. Barring something coming through that represents a bit of a curveball, I think it is. I think it has gone too far. So I think eventually you can get to 2,000 and higher, but at this initial play, not that quickly. I really need to see what's happening in terms of the inflationary front, what's happening with the debt concerns. But given the current set of news available to us at the moment, I think it's probably a bit too expensive.
Now, Jonathan Barratt, on the broader commodity picture, funds have been slashing their long positions, and that's due to forecasting the drop in commodities. Why is that? Because commodities are viewed generally as being quite a strong play.
Look, they are. It's either whether they're just trying to grab profits where they've had them before, which is reasonable, but people are still concerned out there that the chance that we're going to go for a double dip. Optimism, I think, is certainly there, but some people are feeling there's a 30% chance that the global economy does double dip. As a result of that...
What's your view on that?
No, I don't think so. I think that it's much easier for the economy to double dip with primary imports at record highs, like oil at 100, but not with oil down at 85, not with copper where it is, not with somewhere where our grains and our softs are down. And all those areas, they're a lot lower than they were, so I think the chances of us to double dip, I think, is a little bit more remote than what people suggest.
Those commodity forecasts, though, if they are, if we do see a drop in commodities, Australia's domestic economy is so hinged on that sector. What does that mean then?
I think Australia is a bit more of a concern for Australia, and it sort of puts us a little bit isolated because the commodities start to come back. We're in that basket, so we're going to have a concern here. But Australia also has concern on its consumer confidence and business confidence. I mean, they're at levels not seen since 2008. So we are in more of, I think, a precarious position than what people actually really think. And it'll be interesting to see the rhetoric with the RBA as to what we're going to be on interest rates, because most people are looking for interest rates to stabilise, if not go lower. Well,
I saw a note that overnight it's speculated that the RBA will keep interest rates on hold until mid-next year. Are you of that view?
I'm of that view. And there's some people out there in the market as well saying that the next move will be a cut as well. So people are starting to think that if commodities start to come under pressure, there's not as much demand for our two-speed economy. Business confidence and consumer confidence is way down. You're certainly not putting interest rates up. Stabilise or lower, I think, is the way to go at the moment.
All right, Jonathan Barratt, we'll have to leave it there. Thanks for your time.
Thanks, Whitney.